Hello bro and welcome back to the new video. So before we start, sorry, because I noticed, man, that in the last video I forgot to adapt the voice of the music a bit, so sorry for that. But now today we are going to analyze this stock called Alphabet Incorporated with the stock ticker GOOGL, which is basically Google. And the reason why we will analyze it is because today or yesterday, I'm not sure right now anymore, they published earnings. Okay, they published earnings report and we will take a look. Okay, and as always, all the data that we will analyze is gathered here in my Excel table. And before we start, here are some rules, so basically what we will do is we will analyze the data for the last 10 years because this will give us a better perspective of the development of the company. Then we will decide whether we should buy or sell this stock based on the data that we analyze. And at the end, we will analyze the good things, the bad things, and then have the final decision, okay? And now let's go straight into it. So the good things, bro, are that literally the whole income statement shows an amazing growth, bro, except of course capital expenditure and net income, okay? But otherwise, bro, take a look. Total revenue is exploding, gross profit exploding, operating income exploding, net income exploding, gross profit margin is well above 40%, what we want to see, and net income margin is also well above 20%, what we want to see. So basically this is crazy, this is absolutely crazy. And I think this is the first time ever that we saw income statement in such a good shape, okay? And now we come here to the balance sheet and you can see that the retained earnings are also growing through the all years, which is absolutely amazing because that means that the company is reinvesting more and more money back into itself instead of paying it as dividends to the shareholders, okay? And then you can also see that return on equity here, it's well above 10%, what we want to see, and currently it's around 25-26%, which is so good, bro. Like, you cannot, if you would see me right now, you would see that my face is completely shining, okay? And what is it even better is that debt to equity ratio is probably for the first time in my life lower than not only 60 but lower than 50%, bro. This is absolutely fantastic, man. I cannot believe this, and when I did the calculations, I was so surprised, I was so surprised and at the same time so happy. This is what we want to see. This is what it means to have a good management and good debt management, okay? This is absolutely perfect, man. And also the next thing that is good is capital expenditure, because as you can see here on the graph, it's also growing through the all years, which means that the company is reinvesting money back into itself to buy new property, to buy new equipment, new machines, new computers, and so on and so on. So basically reinvesting the money back to buy good equipment, okay? Because after all, Google is tech company, so they need to have good equipment. That makes perfectly sense, you know what I'm saying, bro? Nah, but jokes aside, man, now we unfortunately have to come to the bad things. And the bad thing, probably the only bad thing in income statement, man, is capital expenditure divided by net income. Because what does that mean? So that means that the more they expand the business, the less income they produce on that expansion, okay? Because as you can see here, in 2014, they made around 78%, okay? That means that each investment was paid by 78% of income. Do you know what I mean? And here also you can see 104%. So they got the whole return on investment back plus 4%. That's crazy, man. But then unfortunately that started to fall down, okay? And now we come to the balance sheet, and obviously you can see that long-term debt and total liabilities are growing, especially long-term debt. So that doesn't necessarily mean that this is a bad sign, maybe the company is just reinvesting money back into itself, getting loans, because if you have a loan then you don't have taxed money, because loan is basically untaxed money. That's why all the giant companies have so many loans, and as you can see here, the loan is big, but the debt to equity ratio is still below 50%. So this is not a bad loan, this is a good loan, okay? Because you can also see that retained earnings are growing through the all years, so this is more than confirmed that this is perfect for the business, okay? And now we come to the cash flow statement, and the cash flow statement, bro, is probably one of the worst things that this company has, okay? Because as for me, dividend investor, they do not pay dividends, which is the worst thing that you can have if you are a dividend investor, okay? Because you want to have that free cash flow, okay? And then when we also see the P/E ratio comparison, here you can see the top 8 competitors of Google and their overall P/E ratio, so basically the average is around 85, and this company, so Google, has around 30, let's say, which is of course way better than the competitors, but still worse than our preferable value, which is 15, okay? So unfortunately, the stock is overpriced in our terms, but underpriced in the terms of the competitors, okay? So here we have a bit of mixed feelings, but I decided that when we evaluate the company, we want to be as harsh as possible, so we of course mark that as a sell, okay? But the next bad thing that is in regards of this company is intrinsic value. Intrinsic value tells us what is the fair value of this stock, okay? Based on the complicated calculations about dividend payments and cash flow statements, okay? And here you can see that the fair value of this share should be $120, and right now they are trading at 155, which gives us the difference, the overpriced difference of $35, which is what we not want to see. We don't want to see that. When we are investing in companies, we want to see that we are buying undervalued companies at the amazing bargain, okay? And with that being said, bro, let's come to the final decision. So the final decision, bro, is quite optimistic, okay? I would say that you can buy this stock, but you have to sell it after some time, okay? This stock is literally almost perfect, okay? The company has fabulous financials. Just look at the income statement, almost perfect. Look at the balance sheet, bro, almost perfect. Like, I cannot stress enough, bro, how good the financials of this company are. But for me personally, as dividend investor, bro, the big no-go is that they do not pay dividends, okay? And additionally, based on intrinsic value and P/E ratio, they are a bit overpriced, okay? So my professional advice would be, bro, that you should buy this stock today and then sell it afterwards, okay? Don't hold Google stock forever, because you will not receive that free cash flow through dividends, okay? So basically this stock is only to increase your equity. This stock is only to make a quick profit, and that's it, okay? So if you want to be a bit more risky, then buy this stock no matter what, if it is overpriced or not. Buy it and sell it in maybe 1 or 2 years. Because right now, bro, the price dipped because they had some rough, I think, financials, because the Meta also fell, and that's why the Google is obviously connected, so the price also might have fallen a bit. But still, bro, those are just short-term shocks. If you want to make money, bro, and if you like a bit of risky investment, then buy this company and sell it in 1 or 2 years, okay? And with that being said, bro, do the hard work and see you on top of the world.